I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Cameron Brownjohn, CEO of Federation Asset Management. Welcome, Cameron.
Thanks, Peter.
Can we start by talking about why now is a good time for private equity investing, given we've got high interest rates, we've got inflation, we've got fears of a recession? Is it a good time?
Yes. Generally, over time, there's plenty of data that represents private equity to outperform listed equity. And good private equity managers outperform good listed equity managers. I guess the reason for that is manifold, but in the current climate where you might foresee slowing or negative economic growth, you might see rising or high cost of capital, high interest rates, a high inflationary environment. Private equity has the ability to structure investments to suit that climate, versus a listed equity investor can buy shares. And the only lever they can therefore pull is, do I buy shares at a high price or a perceivably low price? So private equity can play around with price and what price they would pay for an investment at any given time, but also structure, for example, preferential terms, board seat, additional information rights, perhaps preference equity, perhaps a convertible note style structure. And those sorts of structures we have learnt at Federation can protect an investor's downside as well as still produce the same upside that you would otherwise get from a listed equities investment.
So it's the flexibility to structure the deal rather than the macroeconomic environment at any particular time.
I think that's very much right. I think that if you looked at the data on why private equity has outperformed listed equity, generally speaking, it's been the ability to structure and buy well that has held it in good stead.
And so there's no time when you feel the need to sit on the sidelines if you can structure the deal correctly.
Well, I think that it's important to be patient. I think it's important to be cautious. So yes, of course, there are opportunities to sort of sit out and watch and wait. And some of the world's best investors do this, of course. People will think of Warren Buffett and the way that he behaves, which of course is just be patient, be cautious, perhaps hold some cash and wait for some opportunities, and at the right time invest. And so a firm like Federation, we might invest a couple of times a year, versus if we were a listed equities fund manager, we might be in and out of the market any given day. So it's a very different mindset.
What's the outlook for the deal flow in the remainder of 2023?
Pretty good. So the Federation team has made 8 investments since September of 2018. And to find those 8 investments, we've sifted through over 800 opportunities. So we've invested in less than 1% of the investment opportunities that we've found. And this sort of cadence is persisting. The team is almost like Chinese acrobats spinning plates on sticks, with a great many opportunities in our pipeline, and we may do none of them. We may do one, we may do more. But there are many things to be doing in the current climate, in short summary.
How is Federation different from other PE equity or private equity players who are associated with high leverage? That's typical usually, but you're different.
There are other private equity entities that behave like us. We are not Robinson Crusoe, but if I explain that in a longer hand form, at the one end of the spectrum, you have bulge bracket private equity with their multi-billion-dollar funds. We are not that. At the other end of the spectrum, you have venture capital entities that are investing in perhaps pre-revenue or very early stage companies. We are not that. Federation invests in strong companies, enterprise value $200 to $500 million. I can give examples that are bigger. I can give examples that are smaller, but think $200 to $500 million. These businesses are growing. They have strong management teams. They have strong market positions. They're ideally number one in their chosen field. And some of these opportunities can befit leverage, but many of these opportunities do not. And so within that opportunity set, the call for debt, to your question around leverage, may not be appropriate. There are other private equity firms that also play in this small to mid-market opportunity set that Federation plays in. Where we might differ in terms of your readers and your watchers is twofold. Firstly, Federation focuses on businesses that meet a social and economic need. We are not investing in consumer discretionary businesses. We're not generally investing in manufacturing businesses. We think there are better ways to get exposure to those assets in this country than through private equity. The second area where we might be different in this small to mid-market opportunity set to other private equity firms is that we offer a liquidity solution to wealth management channel investors. So people can invest with us any given month. They can redeem their capital any given month, as opposed to needing to invest into a private equity fund and have that money sit there for 10 years before they get it back.
That liquidity option is a distinguishing feature, is it not?
It is in the marketplace that we play. There are a range of the bulge bracket global private equity firms that also offer a similar product.
What opportunities do you see in the sectors where you're active, like health and like energy at the moment?
If I was to answer the two key mega trends that Federation is really prosecuting, one is the aging population thematic, and the other one is the energy transition thematic. And the aging population thematic, we think, persists for the next generation, so it'll be around for a long time. That to us means that we need to be good at the care sector, healthcare, aged care, disability care, and the like. And if you're good at the care sector, it's our experience that you're also good at other white-collar services, things like education. In addition to that, you'll want to be good at financing businesses. You'll want to be good at insurance businesses, maybe some small segments of the technology sector that play to those aging population thematics as well. And then on energy transition, there is a once-in-a-generation pivot in this country from coal-fired power stations fueling electricity to wind farms and solar farms and batteries and hydro power stations fueling the country's electricity needs. There is an enormous opportunity set in both this aging population thematic and this energy transition thematic. And the Federation team, we think, have Australia's best investment professionals to prosecute those two opportunity sets.
Where do you think Australia is in the energy transition continuum? Are we behind the ball or ahead of the ball? Are we laggards or are we advanced, or we're just middle of the road?
20 years behind some of the countries in Europe, 10 years behind, say, the North American markets, but rapidly catching up.
Cameron, thanks for talking to us today.
Great pleasure. Thank you.